Good afternoon, everyone. Thanks for joining us. And much like Brian earlier, I have also been taking some notes on how to effectively moderate. And my notes say that the clock is over there, to be mindful of that, to not talk about the weather and the snowstorm that Neil and I narrowly escaped and left our families to dig out of, coming from Toronto. And also to be careful not to lump Asia into one because, as some of our earlier panelists pointed out, it is a very diverse and unique region, each with its own merits. But unfortunately, I think you're going to see a little bit of that because we are focusing, at least some of our discussions, on cross-border from Canada and into Hong Kong and other parts of Asia and vice versa. We also have the privilege and unfortunately also difficult task of continuing the momentum that's been established by just a lineup of fantastic speakers ahead of us. But luckily for me, I have the honor of being joined by our three very distinguished panelists, who I will turn to introduce themselves very shortly. A quick introduction about myself. I am, as the heading says, a partner at Macmillan, based in Toronto, and we've been talking a lot about diversification. I have not diversified my career. I joined the firm as a student many, many years ago, and I'm still here today. Macmillan is a national Canadian law firm with offices across Canada. We're a full-service business firm, and I've also, in recent years, stepped into the role of being the co-head of our China and Hong Kong practice. So Macmillan, as some of you might already be aware, also has a long history in Hong Kong and the other parts of the Asia Pacific, stemming for, I think, about 35 years now. And over the years, we've helped many clients establish businesses in Canada, access the Canadian market and opportunities, and occasionally when things go south, help to resolve some disputes. And so with that, I will turn things over to each of our panelists so that they can introduce themselves and tell us a little bit about themselves. Neil? Yes,
great.
please do.
So, Neil Campbell, partner of Sandra's at Macmillan in Toronto. My focus is really foreign investment, international trade, and competition. So all about markets, basically, but from the point of view of helping other people get deals done, get business done, a lot of it being across borders, and I've lived a lot of the growth of China investment into Canada in the more recent years where that's become from a both business and regulatory point of view a more difficult task, and I think we're going to turn the corner on that a little bit in the year ahead.
Okay, hi everyone, I'm Gareth, and based here in Hong Kong, I lead the team that manages the brand and business for Lululemon for Asia Pacific. As I said, based here in Hong Kong. I've been at the brand company for 10 years, here in Hong Kong for the last 5 years. And I'm prone to do this because I'm still used to speaking at places where people don't know Lululemon, but I think Canadian Chamber of Commerce, probably everyone knows Lululemon, but if you don't, it's a Canadian athletic apparel brand company founded in Vancouver in 1998.
Hi everyone, good afternoon. Iggy Chong. I'm very pleased to be here. And first thing to mention, I'm a very long time member of the Canadian Chamber of Commerce, 35 years, yeah. And privileged to be on a governor's board with Madeline and many others. So I am a recently retired banker, having had 42 years across 2 major banks, and one of which was the Royal Bank of Canada. And since the last year or so, I have established with 3 friends a consultancy that focuses on helping single-family offices to professionalize.
Thanks, everyone. So as the topic suggests, today we're going to be talking with our panelists about growth and strategic expansion both ways. Which I think is a necessary part a necessary consideration for most businesses. You know, the status quo might work for a select few, but I think in general, you have to be nimble and ready to move, especially in today's dynamic environment. And so I'm looking forward to discussing with our fellow panelists more about that. And the nice thing I think we have up here today is that we've got 3 panelists who can offer really unique and different perspectives. We've got Gareth, who can speak to Lululemon's, real success story of expanding into Hong Kong and the rest of Asia. Neil, to speak about his experiences dealing with businesses that have enjoyed successes but also endured challenges in terms of looking to expand from Hong Kong and other parts of Asia into Canada. And then we also have Iggy, who will offer us a unique perspective on issues that are specific to single-family offices and family businesses looking to diversify, whether by crossing borders or otherwise. So, yeah, let's dive right in. Gareth, we'll have you kick things off. Let's talk about tapping into the Asian market. So tell us, how is the Asia Pacific viewed as a region by Canadian companies such as Lululemon?
Okay, I can't speak for Canadian companies maybe, but certainly Lululemon. And I'd say it has changed dramatically, and even in my lifetime at the company. But I'd say it is probably symptomatic of at least companies within our industry, within consumer products, retail, certainly in apparel sector. So I'd say originally, from the foundation of the brand till about 10 years ago, Asia was essentially a production source. This is where most of our fabrics, most of yarns, most of our clothes were produced in Asia, in the markets spread across Asia. And essentially, as a company, that's what Asia was seen as the production house for clothes that ended up in consumers' hands in North America and even Europe, etc. I'd say about 10 years ago that shifted. So from about 2015, the shift and the power of the local consumer here. So I'd say from about 2015, from our side as a company, we've really seen this as an opportunity to tap into that consumer that's based here in Asia across all the markets, as you say, multiple markets across the region. And it's come up a lot of times today, but just the sheer sort of demographics of the size of the population here, the increasing wealth of the population, but also I'd say other factors like sort of health and well-being is just becoming a much bigger factor for the consumer here in Asia. So I'd say for the last 10 years, we've certainly had a strong expansion plan in Asia and focused a lot of our resources in expanding in the consumer side. So that's for us, obviously, brand campaigns, creating product for the local markets, retail, e-commerce, all the things that go with scaling a brand in local markets. And I'd say so much so in the last couple of years, it's actually driven the majority of the growth for the whole company. It's not just Asia growth is successful, but for the whole enterprise, Asia has been driving the significant growth for us as a company. So the third phase now, which I think we're just sort of at the tipping point, and again, this is probably consumer sector, not necessarily Canadian companies, but I'd say consumer and certainly fashion apparel. We're seeing the strength of the Asian markets, the Asian consumers, is driving brands and companies to operate in a different way, that you need to now get your insights, your concepts are increasingly coming out of Asia. Historically, most fashion brands would have had their roots in Europe. More sports brands would have probably been a bit more North America. All the trends, all the concepts, all the innovation was coming from their home markets. I think we're at the tipping point now. That's now shifting to Asia. It's no longer just because there's a healthy consumer base. It's now this is where trends are coming from. If you follow anything Korean, it's K-pop, it's K-beauty, it's K-fashion. It's Korea is one of the markets which is truly driving global trends and global innovation, which has only really happened in the last couple of years.
And so it's really interesting you mentioned that, because over the years that I've visited both Hong Kong and the mainland, I've really witnessed exactly what you're talking about over, the recent years, this shift to a much more health conscious kind of focus, which I think followed the boom of wealth. And it's great to see Canadian brands like Lululemon kind of really succeed and operate in that environment.
A little bit of luck, a little bit of skill, probably a bit of both.
But tell us, what do you think, what role does Hong Kong specifically play within Asia? And do you see that changing?
Yeah, I'd say Hong Kong has always played the role of a hub. I'd say both in that initial phase. We put our first operations in Asia and Hong Kong in 2009, and that was well before our first store didn't come here till 2015. And that was because of this production source across Asia. And there wasn't virtually zero of our product gets produced in Hong Kong. It was because of everything, again, that's gotten mentioned this morning and this afternoon. It's around the environment, the trade and logistics, regulatory, legal frameworks, transport hubs. It makes it a great place to be a hub. So I'd say it was a hub for the production side for the first sort of 10, 15 years of operations. Even now, for us at Asia Pacific, Hong Kong as a market, it's less than 10 million people. It's a relatively small consumer market, but it's still our Asia Pacific regional hub because of all those things. We manage the region from Hong Kong because it has all those characteristics that you want in that sort of hub system. So I say it has been, and we were talking at lunch of, I've been here 5 years, and the question I get asked the most, probably local here and people who've lived in Hong Kong, isn't it different? Isn't it changed? And what I've learned is the answer is yes, but it's a dynamic city and it always changes. The same would have been true 10 years ago, 20 years, 30 years ago. And as long as it keeps moving and changing with that dynamism, I think it continued to play that hub role for us and for many companies.
I think I would entirely agree with you on that. Being on the ground here, seeing Hong Kong, it very much is a very dynamic and international platform. And so maybe we'll turn things over to Neil, and we'll shift a little bit now, looking into Canada. So Neil, there's been a fair bit, and that might be an understatement, of media coverage on Prime Minister Carney's recent visit to Beijing, which is very well timed for this particular conference. So we're very excited about that. And I think in recent years, one of the main deterrents of inbound investments from Hong Kong and mainland China has been the application of Canada's FDI regime, particularly with respect to investments from China. So do you think after the Prime Minister's visit that we will see meaningful changes to the treatment of such investments in the near future?
So I think his Davos speech probably got even more coverage than his Beijing visit, but I'm going to talk about Davos unless somebody asks a question about it later. I think the answer to your question is yes, yes. Let me make 4 quick points about why I think that. So the first thing actually is about the Carney government and how they are governing, and this is governance led by a business person. This is quite different from governance by your typical up through the ranks political person. There were a lot of skepticism initially about could he do this, right? He has relatively limited political background. And so that's the style of decision making that we're seeing. You see that in terms of the absolute prioritization of two-way trade and investment diversification, having diagnosed the U.S. dependency problem really quite early on. You see that in terms of the sort of large portfolio of major new projects that are going to be expedited in the basic attitude of we've got to figure out how to get stuff done fast, which we aren't historically good at doing. We can do things, but not fast. We're going to do things much faster, strip down a lot of the internal trade barriers. So that's a really positive sort of macro level foundation for the more specific topic we're going to get into. So on the Beijing visit, I think the output is quite remarkable. I think it exceeded expectations by quite a large margin. There's a ton of stuff in there that we don't have time to talk about in this session. I'm just going to zero right in on the investment pieces. And if it started and ended with countries will agree to try to work on investment in areas of mutual interest, that would have been a platitudinous statement, and on we go. But the next 3 things are quite interesting. One is China welcomes Canadian investment in 6 listed sectors and other fields. I won't list them all. The next thing is Canada welcomes investment from China, in particular in energy, agriculture, consumer products, and other sectors. That is a lot of particularity, And then the last piece is a mutual commitment to work on the transparency of our foreign investment review processes, which has been a significant part, I think, of the challenged environment in getting investment done. So I think that is the, for me, relative to this session, the really key takeaway out of Beijing. In terms of our foreign investment review regime, I think that where we got to in the last 5-ish years with respect to China investment was a tendency when there was a potential national security issue to go to the harsh end of the spectrum, that is to say, to block deals, to tell parties they were going to block deals and have deals abandoned. I had one of those that we thought we were going to be able to negotiate a resolution on and couldn't. We have stuff being ordered to be divested. The critical minerals will, of course, have caught all of your eyes a couple of years ago. We have wind-up orders telling people to shut down their existing Canadian businesses that were discovered and run through a security regime after they were already set up and running. That's going to change, in my view. That's not the way in which we approach decision-making in respect of most other jurisdictions. In most other cases, we are looking at trying to identify problems and solve problems basically using negotiated undertakings, negotiated commitments. And we've been in a zone of discretion where we've been choosing the harsh end, and we're going to, I am quite certain, move back with respect to China into, if there are issues, and there will be some legitimate issues, that there'll be room for people to negotiate those kinds of resolutions. So a super interesting development just a week or so after Beijing is TikTok. So some of you will know TikTok was one of the companies ordered to wind up its existing Canadian subsidiary. That's been under a year and a bit judicial review challenge. And right after Beijing, the Canadian government has settled that legal case by agreeing to have the cabinet order to the wind-up order basically set aside, agreeing to do a fresh review. It's not clear whether the fresh review will end with no commitments or some commitments, but it seems pretty clear to me that it won't end up with another wind-up order. So I take the timing to not be coincidental. I have no inside knowledge of that. I'm just reading the developments as we see them. So where does that take us, particularly from a Hong Kong point of view? I think beautifully situated to be a central hub, given its general sort of hub role in both investment and commercial activity, to be a source for both Hong Kong and mainland China and other Asia investments into Canada. I think that's actually quite an interesting and recent turn of events that is pretty good momentum. So the answer is yes.
So that's great to hear, Neil. And I think you make a really good point that, in a sense, it's easy to make statements and offer platitudes, but it's another to take meaningful steps. And it sounds like, TikTok is the first step to hopefully things thawing and things opening up on both sides, both on the Canada end and the China and Hong Kong end, that will lead to more deal flow in the very near future. And I think we're all very optimistic of that. Now, Neil, picking up on, you mentioned that there are sectors from the joint China-Canada announcement, which came out of the Beijing visit. Could you maybe elaborate more on those sectors and your thoughts on, any other sectors and structuring options for maybe non-SOE investments into Canada?
Sure. So, I mean, it's a short list if you say there were 3 things on the list, right? But energy and agriculture in particular, and also consumer products, pretty broad, pretty timely, pretty important. So I think that's, though it's a short list numerically, a very significant swath of stuff where Canada is overtly saying interested and open to China investment. Now, we're going to have some sectors where investment is going to remain more difficult. We're going to move later this year to a long-promised new pre-filing regime that's going to drive more upfront national security reviews, not for China, but for everybody. And it's going to be geared around a list of sensitive sectors. And you can assume that that's going to include, it's not defined yet, but it's going to include a lot of advanced technology sectors, and it's going to include some critical infrastructure elements, I think would be the two big areas. So those sectors are going to remain much more challenging, but challenging for all countries, not just for China. It's very interesting that we did something in our guidelines about a year ago that in sort of odd language basically said we will also be paying attention to whether we're in the United States of America to buy stuff in Canada. If you want to be a U.S. investor and buy something really critical in Canada right now, cannot assume that you can get that done, which 2 years ago you would assume you would have been able to get that done. But what are the other sectors that I think can be done, the ones that are less likely to raise those kind of national security review issues, at least in most cases? It's quite a long list. Construction, commercial real estate, transportation equipment, industrial equipment, possibly even the automotive sector, a number of other industrial products areas, even mining and metals type projects, as long as you stay off the critical minerals list. And we're going to do some big projects. We're going to need a lot of foreign capital, and so there is going to be an appetite for that. Now, is just your last little point, just a quick word on structure. I do think it's materially different for SOEs. That's a general Canadian line of thinking, that an SOE brings with it the potential for foreign government influence that may direct a Canadian business to act in a non-commercial manner. We have guidelines around that. We have a history around that. But if we get outside of, let me sort of plant into Hong Kong, the most notable thing about Hong Kong is your amazingly robust capital markets. If you're dealing with publicly listed companies in Hong Kong that are not SOE controlled, that's a very interesting starting point as a structure in terms of trying to do investments, even in potentially challenging sectors in Canada. Probably not enough just to say we comply with the capital markets rules in Hong Kong to close off all national security issues, but a great place to start to negotiate the kinds of incremental undertakings that are supported by that kind of a rigorous, proper business governance structure. I think private company investments also lots of potential. Again, sometimes some undertakings needed to make those work, but lots of potential. And then the ones that are most difficult, joint venture type structure, not used a ton, but can make business sense and can certainly help from a regulatory point of view. So put a Canadian partner into the mix, you bring a level of assurance that the decision making will remain commercially oriented, and puts a discipline on that sort of risk that's at the bottom of all national security reviews, which some foreign government at some point in time for some reason may do something that is unhelpful to some serious interest in Canada. So joint venture structure was something we said we would entertain with even SOEs in the oil sands about 15 years ago when we were having a real issue there. It's a structure that can make sense, again, coming out of Hong Kong or elsewhere in this environment. So lots of ways to do things and lots of sectors to do them in.
I think that's great insight into kind of the strategic thinking that can go into any given investment from anywhere. And we're not just confined to Hong Kong and China. But as a public company lawyer, I will just note, following up on your points on the public company side, is that I think one of the benefits of Hong Kong is it really does have a very sophisticated market that has deep knowledge and a great international reputation. And so to the extent that can be leveraged, I think that will be just for the benefit of everyone. So Iggy, not to leave you out, turning you now for a perspective on private investors, single family offices and family business investors or entrepreneurs, again, very topical for this audience. Talk to us about what goes on in the Hong Kong Canada corridor.
Yep. Thanks so much, Sandra. So I failed to mention earlier that most of my banking career was dealing with private wealth, leading teams covering single family offices, but also what's called the ultra high net worth market in Hong Kong. So what I hope to do is just share some numbers. I'm a banker or ex-banker, so we'll start with some numbers and maybe a few stories, and hopefully come up with a human-centric punchline at the end. So start with some numbers and some definitions. So how many times larger in terms of GDP is Canada than Hong Kong? Would anyone like to throw out a number? How much larger? Canada versus Hong Kong GDP? It's 5.7 times larger. Another definition, assets under management. I think most people are familiar with that term. If not, it is a pretty reliable number because it is sort of a number that banks need to report to regulators. So you file your assets under management. The figure, and I looked this up and I was surprised, the figure of total assets under management in Canada compared to total assets managed in Hong Kong. Bear in mind, we're talking about Canada, which is 19 million square kilometers, in Hong Kong, which is 1,000 square kilometers. The total assets under management in Canada and in Hong Kong is about the same, 4.7 to 4.6 trillion US dollars, all managed in Hong Kong within probably 5 or 6 minutes transit time of this spot. So I don't know if anyone, maybe you kind of knew it's large, right? But Hong Kong's concentration of wealth management, private capital, I should clarify this, assets under management includes institutional, corporate, and private. Fairly reliable figures from the local industry associations point to about 1.5 trillion of private capital, as Sandra was asking me about. And private capital, family offices, ultra-high net worth, that's all kind of a bit of a mixed data in there, because you have private money mixed in with listed company money in terms of the figures sometimes, not that they would be mixed up in terms of governance, but mixed in the figures there sometimes. But 1.5 trillion US dollars of private asset managed in Hong Kong. Now, bear with me on the numbers a little bit more. There is a fairly reliable, it's not a survey, but it's a report which is based on, how should I put it, their projections, basically, by a subsidiary of what used to be called Euromoney Institutional. And they came out with a figure of 17,500 individuals in Hong Kong that have more than 30 million US dollars net worth. And that's traditionally seen as the definition of ultra high net worth. Coincidentally, 30 million US dollars is also the figure used by the Hong Kong government in its most recent investment scheme to promote family investment holding vehicles, which is the term that's used, FIHVs, in Hong Kong, which is an incentive scheme to encourage more family offices to come to Hong Kong. So that figure is also projected. There's no kind of listing of family offices, the ultra high net worth individuals in Hong Kong, otherwise that would be in great demand. But that figure is 2,700 family offices in Hong Kong, according to reports widely used by the government. So where am I going with this? So it was mentioned a bit earlier that you kind of turn left and right in Hong Kong and you bump across a Canadian. So how many percent of that 15,700 ultra high net worth individuals or 2,700 single family offices are linked to Canada in some way? Could be quite high, perhaps as much as a third. So all to say, and where I'm going with this, is that a lot of investment decisions are not necessarily made purely with an economic bent in mind, as in it's not necessarily the highest ROE. Sometimes it is the place that you're most comfortable investing in. What does that mean? That could be a certain metric or feeling about the downside protection, the comfort level, or perhaps just an emotional liking of the place. And I think my point there is that the unique thing with Hong Kong and Canada is long-standing historic ties. Just recently I met someone randomly, and he was saying, yeah, my family's Chinese in Hong Kong. My family's been in Canada since 1852. So not all Chinese in Canada are recent immigrants at all. This is really, Chinese are very much a fabric of Canadian society. And when family offices invest, they bring those things into mind. So I said I'd mention some anecdotes. So obviously in my time at RBC, I wouldn't be able to talk about any deals whatsoever, but there are some fairly well-known, in the public domain, investments that may not be well understood as actually private or family-driven type of investments. So the largest I know of, which may not be the largest at all, but just the largest I know of, is actually a very large LNG extraction project in I think it's Manitoba, Alberta, and British Columbia spread across, which was concluded about 5 years ago for an undisclosed sum, but then the sort of subsidiary or the complementary extension of that project was, or is, a billion-dollar or multi-billion-dollar LNG port on the west coast of British Columbia, which is estimated to be, I think it's in the 3 to 4 billion Canadian dollars in terms of size. And that was concluded by basically an Indonesian family office, a family with and family office in both Hong Kong and Singapore, all very, very public. There is another very large, I think it's about 1,200 acre hydrogen extraction, or hydrogen extraction through electrolysis site in Vancouver Island, which is also owned by the private wealth of one of the largest public companies in Hong Kong. And my point is that these projects, these large scale investment opportunities in Canada are sometimes not just driven by, well, there's a good economic prospect there, but also by the fact that someone in the family likes Canada.
One of the many reasons I enjoy doing things like this is I learn something new every day, and particularly when I'm speaking and engaging with experts such as yourselves. And Iggy, those are just astonishing numbers to me. It's incredible. And I look back to kind of the beginning of my career. Like, family offices in Canada were, I would say, a pretty foreign and unheard of concept. But I will say in recent years, we've had, and I personally have had, a lot more inquiries from family offices, from consultants, kind of reaching out, exploring opportunities in Canada. So, I'd actually like to take this opportunity to just learn more from you. And I'd imagine there's at least certain parts of our audience who feel the same. Tell us what distinguishes the behavior of SFOs or family businesses from, the corporates that we're all, or at least I'm used to dealing with, and also the implications for businesses and startups looking for investors.
Yeah, thank you, Sandra. I'd love to. I will pick up on a couple of words used by Madeline and John this morning about networking, about patience and trust, and especially that word trust. So family offices are, I'll just again maybe put some characteristics around which may not be so obvious. So if you think of people with ultra high net worth, you think generally that you think of hedge funds, you think of very aggressive, perhaps very aggressive George Soros type characters, right? according to my former employer, RBC's Family Office Report 2025, that's actually quite the opposite. As of 2025, when the survey was done by RBC, the growth as an objective, capital growth as an objective within the investment strategy, it was identified by only 20% of family offices having growth as an investment objective, meaning the rest of the 80% was really income yielding or balanced or more about capital preservation. So that is one response to your question in that it's investment objectives are probably less aggressive than maximizing ROE, which you'd have in a public company, kind of, that's one thing to say. I think the second thing to say is that the decision making, and this is why Hong Kong and Canada has a special relationship and this special opportunity together, is in fact, I think a decision making that everyone would make as a private individual, living in or with bases in both places. The decision is often based by where the family has actually lived, and like in Hong Kong and in Canada, like in Hong Kong, I should say, many families, including the ultra wealthy, have still family members in each jurisdiction. And so because they have a family member there in Canada, that becomes a place where they go seeking investments. So it's not that, we think there's a great acquisition opportunity in wherever that we go to make that decision. It's more about we have a family connection there, we have roots there, and that is what drives the investment decision. That's something I've certainly observed. And then finally, I would say that with private families, with single family offices, this notion of trust is really at the core. And what would you consider is what most people consider as Canada's most valuable attribute? Is it, so technology was obviously mentioned. Is it the weather? Probably not. What would it be? The hockey players, the excitement, the game on attitude? Or is it something rather more mundane, like boring and predictable, potentially? Possibly. I think we should not be shy to maybe not use that word, but position and recognize that one of the reasons why Canada is a place that families have gone to and felt comfortable with is because it's predictable, unlike certain other neighbors of our country. And consistently predictable, absolutely. Reliable, thank you so much, Charles. So, and family offices, and bearing in mind what I said earlier about what they're looking for is not necessarily the capital growth, but just steady income, yield. In fact, it just reminded me, 2 years ago, Madeline, you had us on a panel with a good friend from Cheong Kong, Gerald, and I won't quote Gerald, I don't dare, but if anyone wants to look back at the reasons why Cheong Kong is so heavily invested in Canada, you might want to look back at the CanCham website where it's where his talk is still on. So this notion of reliability is really very, very important. And so going back to answer your question, I think family offices, private capital, are really looking for reliability as one of their top priorities. Thank you.
So when you asked that, Aggie, the first word that popped into my mind was safe, which I think is again, a variation of that, right? That Canada is a safe place.
Thank you,
in a variety of ways, both in terms of livelihood, in terms of finances, and I think that traditionally has been a great, appeal to many people seeking, whether to relocate or to deploy capital. And the one thing that's been reassuring is these things that we talk about, the reliability and that trust that you talk about, that's so fundamental. That's a thing that AI, I think, will not be able to predict, at least to replace, at least in the near future. So perhaps in the final few minutes we have, I'd like our panelists to just shake their eighth ball and tell us, are there any opportunities you foresee, whether in Canada, Hong Kong, or other parts of Asia, that businesses or investors can take advantage of to kind of, going back to our theme, best position themselves for growth and prosperity?
Yeah, I can jump. Mine's from a consumer perspective because that's, I guess, I focus on that side. I'd say the brands, companies that are able to infuse Asian trends, Asian culture, Asian, I guess, guest customer requirements into our brand, into our product, are the ones that are going to be successful. Again, in my space, if you look at fashion, brands traditionally have a strong DNA of where they come from. We are Canadian. We expose Canadian imagery in our stores, our product line, etc. We come across as Canadian. But I think increasingly the brands that are going to be successful have to marry that with a little bit more local relevance that most brands currently do. So that's our job, is how can we still be Canadian, but with Korean flavors, Japanese flavors, Chinese flavors, and you're not alienating local customers. You're actually enhancing your value to them because of that blend of what you're offering. And it's a very hard thing to do. It's like be a chameleon because you can't be everything to everyone. So how do you balance that as I guess a consumer-facing brand is going to be the challenge. But those are the ones that are ultimately being successful. I don't think you can be successful anymore just saying we're Canadian, and if you like Canadian, great. If you don't, go somewhere else.
Neil, any thoughts?
Let me do a trade themed piece just really quick. So the U.S. protectionism, the tariffs that are closing up their market. We've talked obviously about how that's going to drive Canadian companies to look elsewhere. It's also going to result in a whole lot of other countries around the world facing a closed U.S. market and to some degree opportunities for others to sell into Canada more. We often get a lot of diversion when the U.S. market gets more closed, but also I think a lot of competition internationally for the remaining accessible markets. So Canada's been on a very clear, very long open trade, free trade mission. The Europe Agreement, the CPTPP, where the U.S. pulled out, we went in, all sorts of other bilaterals. The one that's up next, that's in process, and Carney's other visit, the APEC outing, was we're expediting the ASEAN negotiations and trying to get those done this year. That's the next sort of add-on to the CPTPP agreement. We've already done the core of the work on a bilateral with Indonesia. So I see that sort of Asia region more broadly as another big opportunity that is certainly there, we expect to be there for Canadian companies.
That's great. Iggy?
Just picking up that theme on networking again, as was mentioned, I think we have a great opportunity, obviously with the Chamber, with the Canadian community, to keep double-clicking on that networking. But maybe I would just add one more little twist to it, is the network with the with reliability as the intent. Give before taking, and really be reliable, because without doubt that brings value in the end.
Absolutely. Thank you all so much. I know that, we've got a little bit of time, so to the extent there's any questions. We got one lined up. All right.
Hi, thank you. My name's Ann Copeland. I've been very involved with the Chamber since 1996, but I'm here to pose a question that's come from our online participants. A very easy question. Given the unsettling, changing times that we're in right now, what do you predict for the future?
Wow.
Is this being recorded? Are we going to look back on this at the next? I am optimistic. I think the recent years have been challenging, both domestically and sort of cross-border wise between, Canada and China and Hong Kong. But there definitely is, as noted, a sense that things are changing and things are going to change rapidly. We've seen TikTok. Just this morning, there was a massive $5.5 billion gold company proposed acquisition announced by a Chinese acquirer of a Canadian gold company with assets offshore. So we'll see how that plays out. But I think we are taking kind of recent events as encouragement to take the next steps that perhaps we were hesitant to take. And so I see great things. I'm going to leave it at that. We got another one? Yeah.
Just a quick question, perhaps maybe more directed to Iggy. I know I was at AFF in 2020, and they talked about the stock exchange sort of delisting, making it mandatory for ESG, social impact, and it just triggered my thought around the trust conversation. How significant is impact investing? Is that a trend that's also influencing through the family offices? Like, do they as a trust signal or a de-risking signal? I'm just curious because I haven't really, more just getting a temperature check on how is that a relevant factor that's driving engagement and influencing private equity investment, and how like to what degree?
Yeah, I don't have any data or numbers on that one, but certainly in my interactions with these family offices, there's a very clear interest among the younger generation, and I think it's well known that there's this massive generational transition happening. I do meet some local VCs looking at impact investing. I know of quite a successful, actually young Canadian investor who has specifically got an impact assessment program within his family office. So the interest is there, mostly in the sort of what was now being termed, by the way, the rising generation as opposed to the next generation. But that may or may not really translate into action, because there is also a lot of the current generation that is extremely long-lived and is still in control. So the interest is there. When the action will happen, it's maybe hard to predict.
Okay, great. Thank you again to our panelists and for everyone in the audience. This was an absolute pleasure, and I personally look forward to the rest of the conference and the rest of the day. Thank you.